Hey everybody, Courtney Smith here with our TradeSmith video newsletter. Big changes, although this page is the same as it was last week. We've seen a lot of big changes in the market this week, and I'm really changing a lot of my opinions here. So let's take a look. Well, S&P. Let's go through each of these numbers. I should number these, right? Upper left, the orange squiggles. I've been talking about this for a long time now, probably 6 weeks, something like that. And about all the resistance up at the high end of the marketplace. I've talked about divergences. I've talked about a lot of different things, saying that this market wouldn't get any higher than it did, and that we're at the top end of a trading range. Now, I'm not sure where the bottom end of the range is. I don't think it's down to that 1800-ish area. A couple of other things. I talked before, the red line that's humping over, I talked about how we were running out of momentum. The two green lines show an ascending wedge formation, also a sign of a top. And this week, we finally cracked. And we broke that uptrend line. Not a big deal as far as I'm concerned, but nonetheless, we are now making lower highs and lower lows. Now, one of the things that I've done here is I've also shown down at the bottom how this sharp down move over the last few days was accompanied by increasing volume. So volume analysis is confirming what we're seeing. And finally on this chart, you see another orange squiggle on the right-hand side. That's where I think this market is going down to as a first move. So at this point, I think we're putting in a short-term high and that we can have a tradable move down. So down to the 2020 area for sure, maybe down to 1960 to 80 as a further drop. So a few percent drop, but nonetheless, a tradable move. And I think it's finally started here, and I think it's confirmed by the lower highs and lower lows. Same thing in the Dow. I want to show you here, this is the NASDAQ, and this is one of the areas that we were pointing out divergences. And once again, you can see the NASDAQ has been cracking much harder than the S&P. So technology stocks are being hit harder. And once again, look at that volume down there. It's just confirming that increasing volume is confirming that the real power in the market right now is down, not up. Seasonality, still bullish. If we break that 108 level on the Russell 2000, though, I'm going to start moving to a much more defensive posture than we are now. Good chance we don't make it down there. Good chance we just get down towards that area. Our normal seasonality here, it would be all election years, which is the top blue line. But as I said, look, we had what we called the down trifecta, which is the January barometer. This is from Stock Traders Almanac. First 5 days, January barometer, all these things, Santa Claus rally, were all negative this year, very unusual. And notice that right now we're supposed to peak out at the beginning of May. Guess what? We're at the beginning of May. We're supposed to sell off until July. That's the black line there. And that seems like a pretty reasonable theory to me. I'm going to go along with that seasonality. The yield curve, however, is very bullish. What we do when we analyze the yield curve is we look and see what the pattern of the yield curve was a year ago, and you can see it was quite bullish a year ago. So that's something that tells me we're not going to see a bear market at all. Just one of many things. We won't see a bear market. We'll see a bear move. We'll see a correction, but we will not see a bear market, with a bear market being classed as a 20% or more decline. Asset allocation starting to crack a little as well, so that's turned a little bit more negative. Risk appetite, also, they're running for the hills again. They're going back into utility stocks. They're going back into consumer staples, so people are running away from the risk in the marketplace. That's bearish. Global shares, they cracked as well on heavy volume, as you can see down on the bottom. So that's not helping things out. Japan, I was wrong on this one. Well, I was right originally, but boy, it got crushed last week on heavy volume when the Bank of Japan decided to leave their interest rates right where they were and not go into more quantitative easing. So everybody was rallying in anticipation of more easing. When the lack of easing came, that hurt the market badly. On the other hand, Spain is held up very well. I don't think those 2 down days mean much at all. Unlike the U.S. market, we're not making lower highs and lower lows. It's obviously not as strong as it was before, but still holding up quite well. Same thing with UK shares. They're going sideways, not down. And my favorite, the Greek shares actually had an up Friday. So looking pretty good there. Bonds. Now, I got to show you the next chart, but just take a look at that one. We're in obviously a big trading range. The market behaved perfectly as predicted last week. We should be rallying now, I think, up towards a little bit higher, not too much higher because of this. All of our indicators, all of our bond key factors are now clearly saying higher interest rates. Higher interest rates. That's what the red arrow is saying. Higher interest rates means lower prices. So even though we've rallied for the last 3 days, I think this market's going to turn around right about now and start to go down. Now, we may bounce one more time off that 127 level, but it's looking more and more like we're going to actually crack that and start a big bear market. We got to watch it for another week or so, but there's a good chance we're going into a big bear market here. Dollar cracked again. We talked about this little rectangle formation down there at the bottom, but we broke it hard. Our first objective is 92.30 on the downside. Well, if the dollar's going down, that has a big impact on gold. And sure enough, look at what gold did on Thursday and Friday on heavy volume. I believe this is the beginning of the new leg up. We made a higher close on Friday. This is fantastic. We really want to be focusing on being long gold now. My key indicators are all bullish now. Last week, they were a mixed bag, but they all shifted bullish now. So you've got to be thinking of being long gold right now. Oil, same thing. I was a bit bearish. I didn't really think we'd get too much higher, and I still think we're running out of gas here. So I don't think we're going to get above $50, but the cheaper dollar is certainly going to help. And hey, speaking of things that are really cheap, you really ought to subscribe to the weekly market forecast. This TradeSmith video newsletter, it's super cool. All the cool kids subscribe to it, and you should be one of those cool kids because I know you're pretty super cool. It's a peanut. Go to that website up at the top and sign up, and I'd love to see you as a fully paid up member. And speaking of fully paid up members, hang on just a second, fully paid up members, and we'll get into I got some new, very different, very, very different trades that I've had recently, including some bear trades. We're going to go short some stuff. Yeah, going to be exciting. So hang on, fully paid up members and freebies. See you next week.